Basically, by reducing your down payment, over the next 10 years, your net worth increased by $21,508. What's up everyone, Conrad Neufeld here, and today we're talking about 4 things that you need to consider when deciding what an ideal down payment is. And it may not be what you think. Yeah, in this video we've got charts, we've got graphs. It's gonna be a gooder. The first thing that we have to consider is some of the regulations that govern down payments. More specifically, does our down payment meet the minimum requirements? Unlike rentals that require 20% down, when you're buying your own home in Canada and you've got good credit, a stable job, your debt's well managed, you can buy a home for as little as 0% down. Well, sort of. That'll be a topic for another video, and when I come out with it, I'll make sure to put it in the description below. The true requirement for most Canadians buying a home in Canada is a 5% down payment when you're purchasing a home of under $500,000. The moment you try to purchase a home above $500,000, you'll actually need 5% for the first $500,000 and 10% for anything above that. So in the case of someone buying a $600,000 home, their required down payment would actually be $35,000. $25,000 for the first $500,000 and 10% of the remaining $100,000. In the event that you're purchasing a house of over $1 million, you're going to need, in most parts of this country, a down payment of a minimum of 20% down, and invite me to the housewarming party. So why 20% down if you're buying a $1 million home? Well, in Canada, we have something called mortgage default insurance. You might know these as CMHC fees. There's also Sagen and Canada Guarantee that offer this default insurance. This is insurance that we as Canadian home buyers purchase to protect lenders from ourselves. If we default on our mortgage, meaning we're failing to make our payment obligations, these lenders can go back and try to make an insurance claim to try to get their mortgage proceeds back. In doing so, it takes a lot of risk off of these lenders, but it comes at the additional trade-off of having to also qualify at these mortgage default insurers. I mean, after all, if you were a mortgage default insurer and you had to pay out every time someone didn't pay their mortgage, you would vet them a lot harder to make sure that they will actually meet their payment obligations. So these default insurers don't want to insure big loans. Also in part due to the fact that their mandate is to help make home ownership possible, and if you're buying $1 million home in most parts of the country, it's likely not your first home. But this is also the same reason that people with hard to prove income or bad credit have to also put 20% down, because that's the minimum amount of down payment necessary to not have to get approval from CMHC or Sagen or Canada Guarantee. And it's also the same reason that people that are new to Canada may have to put more than 5% down, because these insurers are essentially trying to reduce their risk profile. That being said though, whatever that minimum ends up being for your specific case, if all you have to work with is the minimum down payment, then that is your ideal down payment. Okay, so we know that there's minimum down payments, but what if we have more to contribute than the minimum down payment? After all, this insurance does have a cost to it. So one of the things that we need to understand is how our premiums change as our down payment changes. When you put a down payment to 5% down, you end up with a premium of 4% of the total mortgage amount. That means that on a home price of $300,000, you're paying a premium of about $11,400. This in turn gets added to your mortgage, and you'll pay interest on that as well. As your down payment increases, however, your premium starts to shrink. Once you hit 10%, your premium reduces to 3.1%, 2.8% by the time you hit 15% down, and once you hit 20% down, you no longer require the portfolio insurance from these default insurers, so your premium will actually be zero. Now you might be getting the impression that a 20% down payment is the ideal amount to put down, but we've actually got 2 more things to consider. Not only does the amount of down payment that you put against your mortgage have an effect on your premium, but it also has an effect on your rate. A few years ago, changes were made to the mortgage regulations, and it changed what lenders could have insured. One of those changes is that conventional loans, that's loans that had down payments of more than 20% down, were no longer eligible for portfolio insurance. What that meant is it now became more risky for these lenders to offer mortgages at 20% down, and that extra cost had to be priced into their mortgage rate. The moment you put 20% down and no longer have that portfolio insurance and are therefore more of a risk to the lender, you see a premium in your rate. That premium on the rate eventually does drop by the time you hit 35% down. So yes, people with 5 and 10% down get the same rate as someone with 35% down, but in between can be a bit of a mess. And this premium in rate carries over at renewal, so the effect is ongoing. Let's say you're buying a $300,000 home and you put the $60,000 necessary to hit the 20% down payment. You'd pay $0 in premium. But you'd also receive a higher interest rate, and after 10 years, you'd have $157,613 remaining against your home. Keeping your home price flat, just to simply isolate that variable, that means you'd have a net worth of $142,386. Compare that with putting 10% down. You would pay a premium of $8,370, and that would get tacked onto your mortgage. But as it makes you eligible for lower interest rates at the end of 10 years, you'd actually have a net worth of $149,169. That's the equity in your home, plus the $30,000 that you're still sitting on from before. And if instead of putting that $30,000 against your home, you decided to invest it and received a modest 4% annual return, your net worth of 10 years would actually be closer to $163,894. Now, given the different mortgage sizes because of the different down payments, it does have an effect on your mortgage payment. That difference in mortgage payment does over time add up to close the gap, but it never fully eliminates the rate advantage that you get by having a high ratio that's putting less than 20% down mortgage. So is 10% best now or what? Well, we've got one more thing to consider, and that's your comfort and your mindset. If all you have is the minimum down payment, and that's where you're at in your life, then the minimum down payment is obviously what's best for you. Or if you're the type where debt really stresses you out, then putting the most that you can down while still keeping some aside for a safety net is the most ideal scenario for you. Over time, though, we live in an era where inflationary pressures will eventually hit, rising our assets and effectively depreciating our debt. We also live in a time of historically low interest rates, giving you a unique opportunity to leverage your capital for larger returns. But that's provided that you can live with peace of mind, not worried about debt, and that you don't make stupid investments and lose your capital. If you could do these two things, or if you don't have the 20% down, you don't need to fall into this fallacy that 20% down is the only way that you're going to save money by, avoiding these CMHC fees. Because if this is a home that you're planning on staying for quite some time, then avoiding those CMHC fees hasn't really saved you anything in the long run. If you've made it this far, thanks so much for watching. Please consider subscribing, hitting the bell notification so you're alerted when new videos come out, liking and sharing this video.